recently read an article called Quick Guide to the 25 Cheapest ETFs. And when NASDAQ means cheapest, they're not kidding. For example, top two ETFs that they list both have expense ratios of 0%. It can't get better than that. Actually, the Fidelity has four zero expense ratio mutual funds, which I think I'll eventually do a deeper dive into that. But for to stay focused here, I wanted to check out this list and see if they're any good. So to begin with, this is Bny Melons Large Cap ETF. So this invests in equities, large cap US equities to be specific, and it follows this index, the Morningstar US Large Cap Index. It says 200 stocks and debuted in April 2020. Um, yeah, April 2020. Actually, a very nice time to start an index fund. It basically caught almost the bottom of the pandemic lows, and it's rallied quite nicely since. In terms of what actually constitutes the Morningstar Large Cap Index, I did some research, and this is on the Morningstar Index's webpage. Its holdings are all large cap US companies: Apple, Microsoft, Amazon, 2 shares of Google, share classes of Google, Tesla, Nvidia, Berkshire, Meta, United Health Group. And if you look at the weightings here, they're it's pretty top heavy. You can contrast that with VOO or SPY or any index that tracks S&P 500 or any ETF that, tracks S&P 500. And the top 10 holdings are a lot of the overlap, which makes sense because the BlackRock, not BlackRock, the Bny Melon ETF tracks the US large caps. Of course, the weightings here are a little smaller because the number of holdings here is only 228. And actually, the Morningstar US large cap index is, let's see, I'm pretty sure, let me see. I think if you just go to Morningstar's website, yeah, they have a style guide, or a style box is what they call it, and it divides the entire market. I believe it's just the U.S. into small, medium, and large, value, core, and growth. And there are some interesting configurations. Like certain days you see large cap does better than small cap, and mid cap is in between. Other days you see growth is losing to value, vice versa. So anyway, so large growth is what that Bny Melon ETF is targeting. In terms of if we want to look into the portfolio in more detail, it's the exact same as what we saw on this page. Let's see, go back one and compare here. Yeah, so remarkably similar. 0% expense ratio for, I think, an index that's pretty well constructed. I think that's very fair. Volume is pretty low, 17,000, but BNY is very reputable. It's not a universal bank, but it's one of the large mid cap banks in the United States. So I don't know if this is necessarily a good alternative to holding S&P 500 index fund. However, I don't believe the ETF itself is actually it's $80. Okay, so it's not as cheap as SPLG, which is a tracker for the S&P 500, which is my go-to because it's only $50. But more on this later. So not bad, not great. 0% is nice. So if you're looking to buy US index that tracks US large caps, this is perfect for you. Next is the Sofi Select 500 ETF, SFY. So this sounds a lot like the S&P 500, but it's SoFi's methodology that determines the 500 constituents. It's the Sola Active Sfy US 500 Growth Index. Decent AUM. Zach says it's a good buy. Expense ratio is 0%. How it compares to, see, I'm comparing it against the, I think that's SPY. Yeah. Of course, if you zoom out long term, that's not a fair comparison. But over the past year, it's not perfect correlation, but it's actually remarkably close. We can even add is it black? Is it B? Okay, BKLC, and see how that compares. It's all. I mean, the market S&P 500 is so top heavy now that all of the indexes are going to look really similar. So I personally, I think SFY is kind of a gimmick, although it is very cheap on a like absolute price basis. So if you're looking for something that you wanted to put in a small account that you're building out and you wanted to buy something very regularly, maybe once a week, then SFY may not be a bad idea. Although I personally would resort to SPLG, which is down here, a little later down. The reason I say SPLG is probably a better idea than SFY is, SPLG is going to have higher fidelity to tracking the S&P 500. And if you think about expense ratios these days, it's really pennies on the $1,000. So for example, like the SPY or VOO or SPLG all have expense ratios of 0.03%. Okay, 0.03%. So if you invested $1,000, every year you're going to pay 30 cents for them to manage that, which is extremely reasonable. Never in history have we had index funds or ETFs that were so accessible. Even like, I don't know, if you had $100,000 under management and you would pay $30 a year, I think that's extremely reasonable. And Schwab's has a mutual fund that tracks the S&P 500 with 0.02% expense ratio. But moving down the list, JP Morgan's Beta Builder US Equity ETF, BBUS, expense ratio 0.02%, offers exposure to 594 US large and mid-cap equities by tracking Morningstar US TME, Target Market Exposure Index, $500 million in AUM and not too high volume. So what is TME? And this requires a little bit more research. So this is a PDF I found. It's from 2019, so it's a little bit dated. But the TME index is designed to get exposure to the top 85% of the US equity market's capitalization that is free float. So shares that are like held that aren't planning to be sold anytime soon are excluded. So I believe something like Buffett's 10% holding in Berkshire won't be counted, or like any or like minority interest that's been held for a long time won't be counted, and even treasury stock may be counted as well. But I'm a little fuzzy on the details, but basically it's all the shares that are freely traded on a market. So 85% exposure to that. So I guess I don't know, it seems really similar to the S&P 500, except it tracks large and mid cap. I mean, that's basically what the S&P 500 tracks. Although S&P 500 is probably going to have less mid cap. The holdings here are out of date. I mean, look at this market cap here. It's 1 trillion Microsoft. that's not exactly that's not exactly accurate anymore. And here's the style box that I put out earlier. So, so this doesn't interest me too much. In fact, when you as soon as the expense ratio gets up to 0.02%, I think you're almost better off buying the SWPPX, which is Schwab's S&P 500 mutual fund, whose expense ratio is 0.02%, and Fidelity's S&P 500 index fund, which charges 0.015%. So yeah, this doesn't interest me too much. But going down, we got a bunch of index funds whose expense ratio is 0.03%. First off, IVV, which is iShares S&P 500 index fund. Let's open that up. Curious to see. It's $400, so pricey. And at that point, you might as well buy SPY or VOO. It's basically the same. And the ITOT, definitely another go-to. Hear people talk about that. I guess a little cheaper, $100. Of course, this is if you don't have access to fractional shares. If you had access to fractional shares, literally any of these index funds would be good. I do know SPY has the biggest options market for it. So if you're looking for if you're looking to get 100 shares and then sell covered calls on that, SPY is probably the best option. But VOO also has the most, or I think the second most assets under management, right behind SPY. VTI, Vanguard Total Stock Market ETF. This tracks the entire U.S. Stock market. So it's like the S&P 500 plus like the small cap. I think that's S&P 400 or maybe 600. It's like S&P 500 is the biggest 500, and then it's followed by the S&P 400, which is the mid cap companies, and then followed by the S&P 600, which is the small caps. So in total, that's 1,500 companies. VTI holds 1,781. It's even more diversified. I don't think this is a bad choice either if you're looking for more diversification. But you got to keep in mind, of course. Let's see, VTI. Oh, this is a Morningstar indexes page. But you got to keep in mind that the holdings here are going to be extremely similar to the holdings in S&P 500. Apple, Microsoft, Amazon, there's no difference. Here's the top 10 holdings in VOO. Seek Alpha at Morningstar is same thing. So number of holdings 510 here. The reason it's more than 500 is because there are some companies with dual class share structures, including Alphabet, that are both publicly traded. Berkshire A is not included in S&P 500. I'm pretty sure there are only 505 total holdings. I don't know what's 510 here. Does Morningstar? Oh, look after this. Let's see. I'm curious what Morningstar has. Under portfolio. Scroll down. So 507. Okay, so it's a little different. But anyway, the holdings and their weightings are going to be remarkably similar. Just one more comparison. So, going down the list, Schwab's U.S. Large Cap Etf. Okay, Schwab's U.S. Broad Market ETF, 0.03%. Here's SPLG. This is what I was talking about earlier. It's $50. Tracks the 500 S&P 500 index. Yeah, 505 stocks in its basket. Has $10 billion AUM. You compare that with like VOO, which has like $400 or $500 billion in AUM. I guess it doesn't say here. If you have Robinhood, that's actually one of the stats in the page. That's actually very useful, in my opinion. But yeah, so I mean, these two don't really interest me. I mean, by the time you're getting, when your expense ratio is the same as like the SPYs, then you might as well just own SPY. Unless there's a really good reason why you think large caps are going to outperform. I guess you could buy this instead of VTI, but I think VTI is very much better known, and Vanguard's track record is superb, and they're it's not a traditional corporation that's for profit. Um, I forgot what the official designation of them is. But okay, so this also seems very similar to VTI. Yeah, 50 S&P 500, S&P Composite 1500 index. Moving down, looks like this tracks another Morningstar U.S. large mid cap index. I don't know. It's again doesn't pique my interest too much, but here we start getting to some bond funds. I personally don't have any bonds. I'm just 100% equities at the moment because I'm relatively young. So I don't know what's good or bad in terms of bond funds, but 0.03% doesn't seem crazy. 0 to 3 month treasury bond, yeah, that's going to yield probably close to nothing, but its risk is also going to be pretty low. It feels like a money market fund. BND is pretty well known, I think. There's also BNDX, which is also Vanguard bond fund, but I don't know. Well, might as well look it up. Yeah, BNDX. Total international bond index fund. Well, this is a total bond market index fund. So okay, so one is U.S. and one is international. Let's see, AGG, iShares Core U.S. Aggregate Bond ETF, and then down here, I just scroll through this real quick. I did take note of some of the Vanguard index funds. VTI, this is a total stock market. So just the US, but total stock market. Oh, no. Wait, yes. That's right. Yeah, VTI, 0.08% expense ratio. I'm pretty sure that's right. Oh, that seems a little high. Let me double check. Just make sure I'm getting good information. VTI, 0.07%. Oh, no, that's VT. Well, I guess we jumped the gun a little bit, but VT is for the entire world. VTI 0.03. Yeah, that's okay. That seemed a little high. VXUS. Oh, I bet this is 0.08%. I must have put it in wrong. Let me just make sure. VXUS. Vanguard Total International Stock Index. Yeah, so this is only international companies, I believe. So the top holdings are going to be Tencent, Nestle, ASML, LVMH, etc. TSM. So non-US large caps, and Toyota is there as well. See, I don't know what the expense ratio for the real estate fund is, but small cap VT, which is the total world, which includes US and international. The expense ratio for this is relatively higher, so I don't know why you would want to pay for this. Instead, you could buy some of VTI and then some of VXUS, but buy VTI in a greater proportion to VXUS, and I think your overall weighted average expense ratio should be lower than 0.07%. But if you just want instant diversification, something that's easy, VT is going to work perfectly fine. VTV is the value fund. And there are a bunch more Vanguard funds that I didn't list. It just gets to be a lot after a while. Um, so let's see. But beyond that, um, uh, I think it's crazy to think about how expense ratios have gotten so low over the past. I don't know. I mean, I didn't start investing until a couple years ago, uh, but uh, post 2016, uh, or once Robinhood began to offer commission-free trades, that really revolutionized how people how accessible the stock market was to retail investors. Commissions when commissions dropped to zero, uh, that made it a lot easier for people to invest weekly or monthly as opposed to quarterly, and that really led companies like Schwab, TDA, all of the brokerages that are a discount or full service to lower their commissions to zero. Um, I think that's really spectacular.